market tanking more than 30% and as volatile as Bitcoin, the only thing we can depend on to stay consistent is our dividend. That is why today we're going to take a look at 20 best recession-proof dividend growth stocks. Now, these 20 companies I'm about to tell you, I got it from articles from Simply Safe Dividend. Now, this article was written before the crash, so quite a bit fundamental had changed due to the virus. So I'll give you my opinion about each of this company in this article, how it may perform during the current market situation. Now, all these companies have dividend yield of 3% or higher, stable business model, solid balance sheet, and proven commitment to maintain and growing their dividend in all manners of economic, industry, and interest rate conditions. Each stock also meaningfully outperformed the S&P 500 during the financial crisis. So the first one is Public Storage, ticker PSA. Public Storage is the largest self-storage REITs in the country with more than 2,400 storage rental properties in 38 states and over 1 million customers. During the last recession from 2007 to 2009, the S&P 500 lost about 55%. PSA share only lost about 38%. PSA currently have dividend yield of 4.67 with the dividend safety score of 96 from Simply Safe Dividend. Now, even though last 2 years PSA haven't been growing dividend, its 5-year dividend growth rate is still at 7%, and its 20-year dividend growth rate is still 12%. And it also has 27 years of uninterrupted dividend streak. That means during the last 2 recessions in 2001 and 2008, it did not cut its dividend. And my opinion about this company stay aligned with this article. Why are consumers spending less during recession? They still need a place to store their stuff. Simply put, the industry is very stable and predictable with slow pace of change. The company also have very conservative balance sheet, earning is strong, investment grade credit rating, and should remain cash cow given the lack of capital required to run this business. As long as people continue experience major life events such as unexpected move or divorce, they will be demand storage warehouse. Therefore, Public Storage appear to be a quality recession-proof stock to consider. PSA currently pulled back 35% from its 2019 high. Now, with the type of business they're in, even if the recession comes, I do not believe 35% of their customer will cancel the rent from them. According to Bank of America, the self-storage industry free cash flow per share fell by less than 5% during the financial crisis. The next company is Brookfield Infrastructure Partner, ticker BIP. BIP is one of the fastest growing and most diversified utilities in the world. Here's BIP diversification pie if you want to pause and take a look at it. BIP currently have juicy dividend yield of 6.57 with a dividend safety score of 65 by Simply Safe Dividend. Now, the score of 65 is still considered as safe. Its dividend growth last year is 7%, the last 5 years is 9% per year, the last 20 years is 11% per year. Now, here's a few things that I like about BIP. First is the chart for BIP look very attractive. The share price seems to increase very stable with very minor pullback here and there. And with the 40% recent pullback seem to be the biggest pullback they had since 2008. And I also like the fact that the total sale year over year increased nicely, besides the last year that it stayed flat. The next company is Duke Energy, ticker DUK. Duke Energy is the largest electric utility in the country and serves 7.6 million customers in 6 states across the southeast and midwest region of the United States. The firm also has 1.6 million natural gas customers, resulting in a highly diversified, stable, and regular cash flow stream. During the last recession from 2007 to 2009, the S&P 500 lost 55%, where Duke Energy only lost 34%. Duke Energy currently have dividend yield of 5.53 with a dividend safety score of 80 according to Simply Safe Dividend. Last year, Duke grew its dividend by 3%. Last 5 years, it grew its dividend by 4% per year, and last 10 years, it grew its dividend by 3% per year. So it grew its dividend at a pretty slow rate. From 2008 until now, Duke chart looked pretty close to BIP chart. Now, here's a few things I do not like about Duke Energy. Its dividend growth rate is pretty slow at 3%, and during the last recession, it did cut its dividend by about 30%. So during this recession, it may cut its dividend again, but at least it's not going to go to zero. The next one on the list is Verizon, ticker VZ. Verizon is a giant telecom business with more than 116 million wireless retail connections. During the last recession, Verizon only pulled back about 34%. It currently dividend yield of 4.75% and have a dividend safety score of 87. It been growing dividend by 2% with 13 dividend growth streak and 29 uninterrupted dividend growth. During the last 2 recessions, it did not cut the dividend, so that is a plus. Now, here's my opinion about Verizon. The current chart of Verizon doesn't look that great to me. Over the last decade, decade it's been underperformed the S&P 500. It currently only gives you 16% pullback compared to the S&P 500 30% pullback. But with the current situation, I don't think it's gonna affect Verizon that much. That's probably why the share doesn't drop that much. So if you want to look for something stable and less volatile compared to the overall market, and you're gonna depend on the dividend payout, then Verizon is a great choice. The next one is Digital Realty Trust, ticker DLR. DLR support data center needs for more than 2,300 customers across the industry such as financial service, information technology, manufacture, and more. During the last recession, DLR only pulled back 27%, so it's pretty stable. It currently has dividend yield of 3.7% with the dividend safety score of 94. Last year, it grew a dividend by 7%. The 5-year average is 5%. The 10-year average is 11%, and it's been growing dividend for 15 years. In my opinion, DLR is a great dividend company and will not get affected that much during this crisis. And this article right here said it all. While it is true that company cut back on spending during recession, digital realty business provide mission critical service. The data being stored and processed in the data center is needed to run their operation. The only thing I do not like about DLR at the current situation is that its share price only dropped by 14%, so you are not really getting it at a deep discount price. But it is great to add it to your list just in case it drop and offer an opportunity. The next company is WEC Energy Group, ticker WEC. WEC Energy Group has grown through 6 major acquisitions over the past 120 years to become the national largest electricity and natural gas utility. During the last recession from 2007 to 2009, WEC only lost 18% compared to the S&P 500 lost 55%. It currently had dividend yield of 3.41% and a dividend safety score of 87. Last year it grew a dividend by 7%, the 5-year growth rate is 9%, the 20-year growth rate is 6%. It has 16 years of dividend growth streak and 18 years of uninterrupted dividend. It did not cut its dividend during the last recession, but it did cut its dividend in 2001. Now I'm going to compare WEC to Duke Energy, since both of them in energy category and utility category. WEC had better dividend safety score. WEC chart show that the share price appreciation is much less choppier and much better than Duke. WEC performed much better than Duke's during the last 2 recessions. Although Duke had better starting yield, WEC had better growing dividend rate. So overall, I would much prefer WEC over Duke Energy. Now right now, WEC have drawdown of 33%. This is the biggest drawdown for WEC since the dot-com bubble in 2001. The next one is Flour Food, ticker FLO. Flour Food is the second largest producer and packaged bakery food in the country. From 2007 to 2009, S&P 500 lost 55%. FOL only lost 1%. FOL currently have dividend yield of 3.55 and a dividend safety score of 62. Last year it grew a dividend by 6%, the 5-year average is 9%, the 10-year average is 10%, and it's been growing dividend for 17 years. The last recession is still growing a dividend. With this crisis going on, I do not think it can affect Flour Food that much because people are still gonna have to eat, and some people are actually stocking up on Flour Food stuff. And it seemed like the market agrees, since it only gave you 14% discount from its last year high. Now the only thing I do not like about Flour Food from its chart is that it had a huge drop from 2016 with 46% drawdown. Besides that, it's still on a pretty nice upward trajectory. With the share price only pulled back 14% and the dividend safety score is 62, I still think there are much better options out there. The next company is Magellan Midstream Partner, ticker MMP. MMP is one of America's largest master limited partnership. The firm pipeline system primarily transport refined petroleum products such as gasoline, diesel fuel from refineries, helping them eventually reach gas station, truck stop, airport, and other use. From 2007 to 2009, during the last recession, MMP only lost 30%. Right now, MMP currently have whopping dividend yield of 13.82%. With that crazy high dividend yield, a dividend safety score is still at 61, which still considered as safe. Last year, it grew a dividend by 5%, 5-year average is 9%, 10-year average is 11%. MMP been growing dividend for 18 years, that means the last 2 recessions, it continued to grow a dividend. With the current crisis and the oil war going on, at one point, MMP share price dropped by 66% from its last year high. From the beginning of 2015, MMP share price seemed to be on a downward trajectory. But from 2009 to the recent sell-off, MMP share price been performed pretty well compared to the rest of the oil and gas sector. But if I have to pick one stock in this sector, this would be it. It have one of the highest dividend yield that I see that's still considered safe by Simply Safe Dividend. And with this huge sell-off, it seemed like the company at the discounted price. The next one is Enterprise Product Partner, ticker EPD. EPD is one of the American largest oldest midstream master limited partnership. EPD is pretty similar to MMP. Both of them is in oil and gas storage and transportation. EPD also have a whopping dividend yield of 12.23%. Also, pretty safe dividend score of 65%. A dividend growth rate last year is 2%. The 5-year average is 4%. The 7-year average is 7%. It also have 21 years of dividend growth streak. Similar with MMP, the price performance is actually pretty good until 2015. But I still prefer MMP over EPD because of the few reasons. It have better share price appreciation. It have higher dividend starting yield. It also grow a dividend at a faster rate. The next company is Realty Income, ticker O. Realty Income is America's largest triple net lease REITs with the highest diversity portfolio of nearly 5,500 retails, industrial, office, and agricultural properties in 49 states and Puerto Rico, leased to 257 tenants in 48 industries. Here are a few of their tenants. It's all the familiar names that you know: Walgreens, FedEx, Dollar General, Walmart, 7-Eleven, AMC, CVS, Kroger, Rite Aid, Home Depot, and many more. Even with the housing real estate bubble where share price of other REITs dropped to the floor, Realty Income share price only lost 43% from 2007 to 2009. Realty Income currently have dividend yield of 5.9 with a dividend safety score of 86. Last year grew dividend by 3%, 5-year average is 4%, 20-year average is 5%. It recently become dividend aristocrat with 25 years of dividend growth streak. Due to its low risk business model, Realty Income has been growing its dividend every quarter since the IPO. And now it had become the dividend aristocrat. Impressively, the REIT had also been able to grow adjusted fund operation per share in 21 of the last 22 years, even during the worst economics downturn since World War II. Now, with the current crisis, I do think it can affect Realty Income a little bit, since a lot of their tenants can ask for lease holiday. But I do not think it's gonna cut its dividend. Not only that, I believe it's gonna continue to raise its dividend since it just become the dividend aristocrat in 2019. And the share at one point dropped more than 53% from 2019 high. That is comparable to the housing crash during 2008 and 2009. So yeah, at this level, Realty Income may be a great value with an attractive dividend yield that is also very safe. Sorry guys, I did not know how long it took me to go over just 10 companies. So I'm gonna break this into 2 parts. So the next 10 company, I'm gonna put it in part 2. So make sure you click the subscribe button, turn on the notification bell. Thank you guys for watching until the end. Again, my name is Kyle, your average investor, and you guys have a blessed day.